Welcome to Thoughts on the Market. I'm Andrew Sheets, Chief Cross-Asset Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about trends across the global investment landscape and how we put those ideas together. It's Friday, May 5th at 2 p.m. in London. The Federal Reserve raised interest rates 25 basis points this week and have now raised their benchmark policy rate 5% over the last 14 months. That's the fastest increase in over 40 years. And for now, we think it's enough. Morgan Stanley's economists forecast that the Fed won't make additional rate hikes or cuts for the rest of this year. In market parlance, the Fed will now pause. The question, of course, is whether this so-called pause is good for markets. In 1985, 1995, 1997, 2006, and 2018, buying stocks once the Fed was done raising rates resulted in good returns over the following 6 to 12 months. And this result does make some intuitive sense. If the Fed is no longer increasing rates and actively tightening policy, isn't that one less challenge for the stock market? Our concern, however, is that current conditions look different to these past instances where the last rate hike was a good time to be more optimistic. Today, current levels of industrial production and leading economic indicators are weaker, inflation is higher, bank credit is tighter, and the yield curve is more inverted than any of these prior instances since 1985, where a pause boosted markets. In short, current data suggests higher inflation and a sharper slowdown than past instances where the last Fed hike was a good time to buy. And for these reasons, we worry about lumping current conditions in with those prior examples. So far, I've focused on performance following a pause in Fed rate hikes from the perspective of equity markets. Yet the picture for bonds is somewhat different. Whereas future performance for stocks is quite dependent on the growth outlook, U.S. Treasury bonds have historically done well after the last Fed rate hike under a variety of growth scenarios, whether good or poor. For now, we continue to favor high-grade bonds over equities, even if we think the Fed may now be done with its rate hikes. We think that's consistent with the current data looking weaker than prior instances. In turn, stronger growth and lower inflation than we forecast would make conditions start to look a little bit more similar to instances where the last rate hike was a buy signal and would make us more optimistic. Thanks for listening. Subscribe to Thoughts on the Market on Apple Podcasts or wherever you listen and leave us a review. We'd love to hear from you.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.